Hello, and thanks for taking the time to listen to the latest update from AJ Bell Investments covering the MPS or the Managed Portfolio Service. My name's Matt, and I'm the Head of Investment Management at AJ Bell, so it's a pleasure to be able to speak to you all today and cover the comings and goings of what's been a very interesting quarter. So as usual, same sort of format as we usually go on. So, what's happening at AJ Bell Investments, anything's happened or changed there. Quick review of performance, review of the markets, and then, look at what we think is going to happen, which I guess is pertinent given the current conflict between Russia and Ukraine. So we launched over 5 years ago now, so we've gone through that magic 5-year mark. Performance has been really strong, as we'll talk about. Now managing over 2 billion. So for those that forensic, you can go through these each quarter and see how that asset number is changing, but sort of continue to grow strongly, and that's managed across a range of different portfolios. So our funds and our model portfolios, that obviously covers all the different types of solutions. So be that actively implemented, passively implemented, a blend of both through our Pactive portfolios, those that are seeking income objectives, or those that are seeking a responsible or ESG objective. So again, we can touch a little bit about that. For example, we launched our responsible MPS over a year ago now, so that was on 1st of March 2021. So we continue to build those track records for those new products and make sure that we give you a good choice of solutions, all of them competitively priced, and aim really to not do anything too extreme, but still be risk conscious in what we do. So as I say, the performance numbers for each of the portfolio here, here we just give you them in absolute terms. Again, you can go through the fact sheets if you want to see how we compare to the various sectors, on both a 1, 3, and 5 year view. For example, MPS 1 to MPS 6 are all in the first or second quartiles. You can see in the short term, performance is negative in absolute terms. And again, it's one of those perverse situations where the lower risk portfolios have done worse than the high risk portfolios. We'll touch on why that is. But again, given the amount of uncertainty in the market, a 2.5% loss is actually relatively modest, given what's happened in certain parts of the market this time around. We've got the numbers for active as well, so not quite gone through that 5-year mark yet for the active portfolios. But obviously launched these back in February 2018. So we've gone through 4 years now. What you can see here is similar trends. So short-term losses, across the portfolios, perhaps a little bit behind the passive portfolios in the short term, really given the fact that the active portfolios have not quite benefited so much from the strong performance of the FTSE 100 and the energy sector, which we'll touch on. But over that longer term view, very similar outcome to the passively implemented portfolios. Both our active and passive portfolios follow the same sort of strategic asset allocation framework, which does give that sort of performance consistency across those two styles of implementation. And then sitting up somewhere in between our Pactive portfolios, again, as you'd expect, performance is somewhere in between the passive and the active, given it's a blend of both of those. So let's start doing a bit more of a deep dive into performance. I always think it's useful, before sort of getting into the weeds of things, sort of step back and try and understand what's been driving the market from a very sort of high lever sort of point of view, and what does that mean? So here we like to look at 3 key things that are going to either drive the market towards a passive style or an active style, because when you look at active investors, they tend to have a bias towards smaller companies. As soon as you move away from the benchmark, you tend to underweight those bigger companies and buy small companies. Not always the case, but in general, you tend to have a bias towards value companies. Again, if you're focusing on companies where valuations are cheaper, that does tend to focus a bit more on a value style. And that's, again, not to say there aren't managers out there that have a very growthy style, but in aggregate, a bit more of a value style. And then finally, again, when it comes to active on the fixed income side, there tends to be a bit more of a bias towards credit and corporate bonds away from government bonds. So what can we say this time? You'd have thought that conditions were actually fairly neutral. The fact that value's done well should have favoured active management, and the other two sort of in the middle. Actually, we've not seen that happen, and that's because the type of value, which is around sort of energies and commodities, is actually an area that a lot of active managers steer away from. But what you can see on the longer term view, on the 1 year view, again, a fairly balanced picture between active and passive. No extreme sort of, all three dials aren't moving towards active, or all three dials aren't moving towards passive, which then means it's actually the stuff at the next level down that's driven things. Your asset allocation, your selection towards different styles and sectors that have been much more fundamental driver, rather than just passive's going to do better or active's going to go better. So you can see that again if you look across some other factors. You can see that the big one that stands out here on the quarter is that on the bond side, you'd have been much better placed in short-dated bonds rather than long-dated bonds. But actually, otherwise, a fairly balanced approach between developed markets and emerging markets, between the pound or other currencies, and between bonds and equities. Again, if you look on that longer view, being in equities over bonds and being in shorter bonds over long-dated bonds has helped drive performance. But again, nothing quite as extreme, and we're looking at the COVID bounce. We saw these dials shifting right to the left or right to the right, whereas now, everything's a bit more in that sort of middle of the range, which means that, again, it comes down to other factors that's going to drive your portfolio returns. So let's talk about, the markets and the economies. Clearly the biggest thing in the news over the quarter has been that Russia-Ukraine conflict. It started affecting the markets before the invasion. So the invasion happened in February, but really since the start of the year, tensions were rising, and that's affected things. Actually, though, that conflict has more been a continuation of a theme, which is the market's seen that conflict as being inflationary. Obviously a shortage of energy and oil prices and the effects of the sanctions continue to drive that inflation or higher inflation view, which was already in the market post-COVID bounce. So it's those lower risk portfolios that have struggled. Equity markets, although they've struggled and certain areas in particular have struggled, there's actually been good parts of the equity market as well, whereas bonds in general have sold off, which is why the short-dated portfolios have struggled a little bit more. As I mentioned, the energy sector was by far the best performing sector over the quarter, and we do actually, from the MPS 3 upwards, hold an energy ETF in both the active, passive, and Pactive portfolios. That returned 42% over the quarter. So despite losses elsewhere, having just a dedicated allocation to that has helped dampen the losses in the portfolios. Longer term inflation continues to pick up in terms of expectations. That's a view we already held. We'd already switched into shorter dated bonds. Again, that doesn't mean we haven't made losses, but compared to the IA sectors, the wider peer group, we've done relatively well. So yeah, as I say, just to delve into that. So those key themes about energy doing well and that playing into different parts of the market, this is just different ways of putting that and describing that. So, you look at the regions, you go Asia and the UK have done well. Why has Asia done well? Asia is heavily sort of weighted towards, for example, Australia. And Australia is a resource mining linked stock market. Similar with the UK, but to a slightly lesser degree, materials, energy, Basic resources are a big part of the stock market there. So that's why the UK and the Asia have done well, whereas other parts of the market, the US, which is more tech focused, has struggled. So again, you can look at it through the lens of regional performance, but it's the same drivers. That Russia-Ukraine conflict, the increase in the energy price that's driven that performance. It's a similar idea here again. High dividend and values done well because high dividend stocks tend to be those well-established mature companies, which again tend to sit in those sectors, whereas growth and quality. So I guess there's two reasons here. Obviously, uncertainty, but also the increase in bond yields. A lot of quality stocks tend to be linked to bond prices, and as bond prices have fallen, they've struggled. So I mentioned here the energy sector well. So I think I just mentioned number 42%. So 42% is the ETF we use, which is focused on the US energy sector. But if you look at this even just through a global lens, you can see that the energy sector in global terms has done very well as well, up 26%, and far ahead of any of the other sectors. So if you've got that call right, if you were well positioned in the energy sector going into the quarter, which is something we initiated that position back in February 2021. Sorry, I was just stretching my memory there. So we initiated that position in 2021. We've held that for just over a year, and since we added it, it's up 90%. So again, really helped those portfolios, and as we call that rotation from quality into value. Longer dated bonds have struggled. So again, we have a short maturity tilt in the portfolios, in particular in those lower risk portfolios where there's a big weighting to bonds. So for a long time we've held the Lixor 0 to 5 year gilt ETF, but more recently, so in January this year, in the passive portfolios we moved into the iShares Ultra Short or Corporate Bond ETF, and in the active portfolios we've moved into the Royal London Short Dated Credit Fund, and in both of those we repeated that move we've done in the government part of the portfolio into the corporate bond element of the portfolio. So that's just summarising what I've just said. Strange quarter performance, real mixed bag. Strange that actually equity heavy portfolios did better because of that energy weighting. Obviously that's not appropriate given the volatility in the lower risk portfolios. They actually struggled a little bit compared to the high risk, but compared to what we saw in the wider context of the market, percent loss is relatively modest, and we did protect by having shorter dated bonds, US tips, things like that. The passive portfolios actually even performed pretty well in absolute terms, given that bias towards the FTSE 100 stocks, energy stocks, things like that. Active was slightly behind passive in our terms this quarter, but still stacks up well against those peer portfolios. And again, our short maturity stance was vindicated. It's something that is probably a hamstrung performance for the last few years, but then you suddenly get quarters like this, and it shows how having a short maturity stance it's a good idea when you're trying to protect from absolute losses. So with it, obviously within the passive portfolios, everything's implemented with ETFs, so I tend not to focus on those individual things. It's those macro drivers. Probably worth mentioning a couple of the actual active positions in those portfolios. So again, it's the same idea where we use active funds with certain tilts, and the ones that are positioned towards value did well. So some examples of that: Dodge and Cox, JP Morgan, US Income. Again, those specific active funds, I think I've already mentioned. The Royal London Short Dated Credit Fund performed well as prices fell. The one other area that's probably worth mentioning, infrastructure did well again on the value trade. The infrastructure sector was up about 7%, but actually the Franklin Templeton or the FTF Clearbridge Global Infrastructure Income Fund actually delivered 10%. So it did well against a sector that also did well. So it helped add in those portfolios. As I said, the detractors really were in the UK space. The active funds we use there, although we do have some with a large cap bias, ones that move away from the benchmarks either have a small cap bias, like Tellworth UK Smaller Companies Fund, or those with a quality bias like the Trojan Income Fund struggled. They did as we would expect, but against that broader benchmark, which was dominated by energy and basic resources stocks, they did struggle. On the income side, again, it was a relatively good performance. We're not getting too excited by this because, again, it shows that when you run a portfolio with a certain objective, you do end up with certain biases. So within the income portfolios, you naturally don't have a bit of a value bias, and that's really what helped drag up performance. In certain market conditions, like during COVID, that worked less well. Over the whole economic cycle, we think we'll do okay, do similar to the non-income portfolios. They have been dragged up by having that value bias. Again, the passive portfolios perform slightly better. Again, but again, really because of the specifics of that FTSE 100 exposure. But over the medium term, the active portfolios have continued to do really well, and that's one area where the active portfolios, over say a 3-year view, have outperformed the passive. And then maybe a note, even on the passive portfolios, sometimes people think that we're just buying passive income. The ETFs we use there are what you'd call smart beta. Horrible phrase, but what that means is it's not just sort of market cap based, or it's not just ranking everything from highest yield to lowest yield. There's a bit of a smart approach there. So there's extra rules to avoid value traps, to make sure there's at least a sense of that income is stable. And that's what you want in these sort of market situations. The energy sector in general will do well, but any company with weak balance sheets in times of crisis tend to struggle. So it is just worth noting that even in the passive portfolios, it's a bit smarter in terms of how those ETFs are put together to tilt away from anything sort of extreme value, which may do less well. So what's our view? So first of all, let's say we were well positioned into the crisis. We'd already thought about inflation and what that means, and if it was going to be persistent. So really the Russia-Ukraine crisis is just a continuation and acceleration of our view, which is inflation is going to remain high and stickily high for a little longer than the market thinks. And that would be persistent. I mean, what's the definition of persistent? Is that 1 year, 2 year, 3 years? More than 6 months, I think, is definitely the case. So we'd already added in inflation-linked bonds. We'd already rotated our equity into more value-focused sectors. We recently added in financials with shorter maturities. There's a lot of things we've already done. So we think that's going to continue, and we're well positioned for that. Despite that long-term uncertainty, one of the things we always get asked as well, what are you doing? Are you making any short-term tactical calls? Are you trying to call the market? Are you moving all into cash? Well, remember, these are risk-focused portfolios designed for the long term. So even with that uncertainty, even if there are short-term sell-offs, we think equities still look relatively attractive compared to bonds. So we continue to think that's the best way to allocate capital in the long term. And again, patting ourselves on the back a little bit, but we think this quarter shows that importance of, even from a passive point of view, where diversification is important. So even if you're taking a passive approach to building your portfolios, you can still get extra diversification by using different sectors, different regions. And this quarter highlighted that, for example, by having separate allocations to things like energy ETFs. Whereas obviously during COVID, we had allocations to consumer staples and healthcare ETFs. So it shows how having that extra diversification can sort of dampen those losses, but still, help keep costs low in the long term. And I'd say that approach is across both the active and passive portfolios. So we keep you up to date. We refreshed our literature a little bit. So new style fact sheets. We've got new literature, new quarterly reports that have been out for the last 9 months now. So keep you up to date there. So keep visiting our website to see what we're doing. Hope you find this video useful. As ever, this presentation is just for discussion purposes, so it shouldn't be constituted as advice. But I hope you found it useful. If you do have any further queries on the portfolios, on what we're doing, please get in touch with your business development team. I would like to think we continue to be something you can use in the background. You know that it's being looked after, and despite costs being low, we do continue to try and navigate uncertain markets. Thank you very much.